know I try to be a good man. I always give it my best. But truth be told, someday I want to go to the wild, wild west.
And now, live from our smokehouse studio, it's time for Real Estate Jerky. All your real estate questions answered by a provocatively lean expert host, Ed Parcaut, MBA, veteran, and president of Lending for Living. And today's special expert guest, real estate advice you won't find anywhere else. Plenty to chew on, starting now.
Hey, good afternoon. It's great to be here. I'm Ed Parcaut, your host. I'm here with my guest, Tom Bryant. He's the managing director of the investment consulting group in Modesto, California. Tom, thank you very much for coming into the show today.
Thank you for having me, Ed.
Anytime. Our number one goal here at Real Estate Jerky is to help you, our listeners, learn about home ownership and how you can take advantage of it. The simplest way to build personal wealth in America through home ownership. Today, we're taking a look at the signs of recession, what they'll look like, what you can do to protect yourself and your assets. Tom, let's dig into our topic, but first let's touch on your background so we kind of understand, our listeners know who and why I picked you to come on the show.
Okay, what'd you like to know?
Tell me a little bit about your background. How did you get into the business? Where'd you go to? Let's go all the way back. Where'd you go to school?
All the way back. University of Oregon, got my degree in economics. Prior to that, La Loma Junior High School, Wilson Elementary,
so you're
Downey High School.
So you're from Modesto.
I'm a local boy.
Okay, and you came back to Modesto, which is not what a lot of people do. All right, so and then what was your first job in the industry?
Started with E.F. Hutton in. Yes, people listen.
That's right. Most people don't know that.
They did. Yeah.
You had to see us on the Real Estate, our YouTube channel, to see what I did. I did that little YouTube, that listen when people say E.F.
Yes, you gave your ear to the mic. Yes,
that's right.
When E.F. Hutton talked, people listened. That was the phrase. We started with E.F. Hutton in 1983, actually.
Okay, 1983. Wow. So
Been there for 15 years, and after that, the internet gave us the opportunity to go independent. We moved with a company called Wheat First Butcher Singer, which was later acquired by Wachovia. Wachovia got bought by Wells Fargo, and then later we left Wells Fargo, and we now clear through another firm called LPL Financial.
Okay. I'm going to go back to 1984.
All right.
What was Monday? It was a bad Monday, wasn't it?
Oh, that was 1987.
Was it 87?
Yeah, it was October 19th, 1987, the Black Monday.
Yeah. What'd you learn from that?
A lot. My nerves were frayed, and I almost lost my house because the market crashed so hard. We had a 30% drop in the market value over a period of 3 days, and it changed my life and my outlook dramatically.
And how you do business, right?
Yes, and it also changed my trust in the investment markets and a whole lot in our government too, by the way.
Okay. So, I mean, it's important for people to know that. I mean, because a lot of people have been doing this for a short period of time, and they don't know when those things happen. Like, I've been doing this for 25 years, and I've been through multiple recessions, the Great Recession. So you look at it differently than if you've never been in one of those situations.
35 years in the business does give you a great deal of perspective, yes.
Okay. And you got your MBA where?
We got it
in
at Boise State.
Okay, in 2006, right?
Mostly over the internet.
It doesn't matter as long as you get it, right?
It was work.
Yeah, and you guys have your CFP.
We are certified financial planners. That came later. 2012, I believe, is when we went through that process. And that in itself is a 1-year process plus testing.
And then they've actually changed that to where before, to be a CFP, you didn't have to have a degree. Now you have to have a degree. Is that correct?
In order to qualify for the CFP exams, you have to have a 4-year degree and at least 3 years in finance business.
That's good. Because I remember before people were saying you didn't have to have one, so you have somebody telling you about your money and they don't really have a degree.
Well, there are a lot of people that call themselves financial planners, and what I would suggest you do is go to the CFP.org and qualify to make sure they are, in fact, certified financial planners.
Because that's important.
It is to me.
Yeah, it is to me too. All right, so we went through kind of your knowledge and everything, and I don't want to go too fast, but one of the reasons I had you on is I called you after I went to a conference, and they were talking about signs of recession and how the recession's coming, and I called you, and you didn't say. I mean, what you said on the phone and everything was exactly what I want our listeners to know about. So let's jump into it. We have about 5 minutes before we go to break, so let's start with there. What do you see out there right now?
Signs of a recession. There are a few, but I don't think that they qualify for a major panic. The signs that I see are an inverted yield curve, which is not an accurate prediction of a recession
By itself, right?
by itself. Yes, it's
And what is an inverted yield curve?
an inverted yield curve is
For our
where
listeners.
the short-term yields on Treasury bonds have a higher yield than longer-term bonds. So in other words, right now, 1-year Treasury is yielding about 1.9%, whereas a 3-year Treasury is about 1.7%. So you can see that the shorter-term yields are greater than slightly longer year.
Which is
terms.
meaning normally your short term is higher than the long term.
No, your short-term yields are always lower than the long-term. The shorter the time frame that you're willing to tie up your money, the less interest you're supposed to get for that time period.
Right. I'm just making sure everybody
I understand.
understands,
So a 30-year Treasury would pay 2.5%, and a 1-year Treasury should pay less than 1. And right now, it's not the case.
So basically, nobody wants to go long term. Is that what
That's right. People who are buying bonds are unwilling to commit for the long term. They're more willing to take a short-term commitment because they feel there's risk in the economy.
So uncertainty in the markets, uncertainty what's going on.
Well, there's always uncertainty in the markets, Ed, as you know, but there's concern that there might be a slowdown in the economy.
So a recession,
Okay.
a slowdown. Well, okay. So what's
a
the
recession-
definition of a recession?
A recession is 2 consecutive quarters with a negative GDP.
And you don't really know you're into it until after it happens.
That's right. It takes 2 quarters to find out of consecutive 2 consecutive quarters of negative GDP before you know
that you're
in a recession. That's right.
So it's hindsight's always 20/20.
Hopefully.
And by the way, anything we talk about today, chart wise or whatever, will be on our Facebook page, so you can go there and go along with us while we're talking. So, all right, inverted yield curve. What else have you seen?
Gold prices are up a little bit. Currently, gold prices are a little bit higher than they have been for the last 8-9 years. Currently, gold's at $1,336 an ounce, and we've been looking at $1,100 gold prices per ounce first of the year.
Now, haven't they been higher than that in the past?
Oh yeah, 10 years ago, gold was $1,800, $1,850 an ounce. That was in response to the panic because we had a financial meltdown, so to speak.
That would be
The Great Recession.
Okay, sorry.
2000. Actually, the gold prices probably peaked. I think it was about 2008.
Now, is gold a good investment in general?
From my perspective, it's not. Gold is a hedge against 2 things: an economic meltdown or hyperinflation. Otherwise, gold is a trader's or a speculator's investment, and it's hard to buy and sell because it's expensive if you buy the actual bullion. So there are gold futures or gold spot markets that you can buy through Wall Street, and that's the best way to buy gold on the short term.
Now, I remember when I was in college a long time ago, my professor said that gold wasn't a good investment because it's the cost of a really good suit. Always, right?
That would be 1 ounce would be a really, really good suit from my perspective.
Right.
But the problem with gold is it doesn't give you any return while you're hanging on to it. Right. It's purely a growth or a hedge against catastrophic events.
And a lot of some people have gold and silver in case of some of these. I don't want to say weird different people out there think about if the government takes over, I have gold and silver and I can keep going.
People think of gold as a hedge against global meltdown or the government taking over, or just they want it in their pocket or in their safe because it makes them feel comfortable. I think that's a fool's move.
Well, because basically you got to then sell it.
Yes.
And then someone's got to be willing to buy it from you.
And if you sell it, you have to subject it to an assay test, which is to test checks the purification of the gold to make sure that you haven't melted it down and doctored it up. So that costs about 10 to 12% of the sales price is what goes into the actual transaction of selling it. That's why it's cheaper just to buy a ETF, an exchange traded fund of gold on the through your advisor.
Okay. Hey, let's go to break, and when we get back, we'll pick this up. Hey, thanks for tuning in. We'll be right back after this break. Remember, if you want to get a hold of it, you can dial #250, say the keyword Real Estate Jerky. Again, that was #250, say the key phrase Real Estate Jerky. Leave us your questions or comments, and we'll get back to you. 10 minutes is up. So am I okay? You doing okay?
No, fine. Yes. I don't know.
I'm trying to make sure we get, we talk about everything.
It's okay.
I want to get to a point from here to the end, and so people understand where we're going.
Okay.
And remember, this is still live, so during the break, it's still on there.
Oh, okay.
So, no cuss words that you don't want to.
I don't cuss.
I said some things one time. It was like, I forgot.
Oh,
yeah, it's still live.
Oops.
That's why it's behind the. Well, no cuss words. It's just, yeah. All right. So when we get back, so we went over gold. What do you want to go from there? Because this is as much. You are the person. So you went to your inverted yield curve. We did gold. What's your next one?
Do you want to talk about Fed policy, or do you want to talk about?
We're going to talk about it all, but what? How do you must have had a process.
Talk about the Fed.
All right, so we talked about 3 signs. We were talking about the signs of recession.
Mm-hmm.
We went over the
Inverted yield curve.
Inverted yield curve. We talked about gold prices, and now what? And then you're going to come in. All right.
Okay, we can talk about the Fed, and then we'll talk about unemployment.
All right. So this next segment is going to be 12 minutes. You know how we are. We're very competitive. I mean, I was off by like not even an eighth. It was really low, and I said, "Here's the difference. I'll call your listing agent. I'll tell them how great you are. So when your buyer's agent sends an offer, I'll call your listing agent and let them know how great you are, where you're at in this. Those people won't do that for you." So I did that, and there was 15 offers on that property. They did 7 counters back, and he got the deal.
Well,
Yeah, so 12 minutes.
You got it, sir. You got it.
Ready?
Oh, yeah, Captain.
do we get music?
Yeah, we're gonna same thing, music.
Oh.
But when I hear it, I gotta hit start. That's
No.
when I'm like,
Long-lasting Real Estate Jerky is back on Power Talk 1360 KFIV.
and we're back. And for those of you just turning in, I'm Ed Parcaut, mortgage advisor with Lending for Living, and your host, along with my guest today, which is Tom Bryant. He is the managing director of the investment consulting group here in Modesto. Tom, we were going out to break. We were discussing whether or not recession's coming and what those signs are. I think the first 2 signs we talked about was the inverted yield curve and gold prices, right?
Yes.
And then, so what else? What are the other signs?
Well, higher interest rates would be a concern. As interest rates rise, that's generally a reflection of inflation. And the Federal Reserve has some influence on short-term rates, and they can influence the economy. And what's going on right now is the Federal Reserve has been raising interest rates for the last 2 years. There's been about 9 consecutive interest rate rises in their discount rate. And so the question is he going to raise the rates or lower the rates at the end of this summer? And there's a lot of discussion about that.
And from what I see in the market, to me, it looks like the market's planning for them to lower.
The stock market has rallied. In fact, it's making new highs yesterday and today in anticipation
this
of
week?
I'm sorry. Yeah, in anticipation of a Fed discount reduction. Yes.
Because when we were talking before you came on the show, you were saying that, or I heard this somewhere, that maybe the tariffs have helped slow the economy, which has caused the Fed to possibly look at lowering interest rates.
Well, it's interesting you mentioned the tariffs, because the trade war that our president is engaged in is it's a dangerous little game he's playing. But if it works, it will definitely benefit our economy. What happened in the first quarter, there was a massive amount of purchasing going on by companies buying raw materials in fear of tariffs coming and making their raw materials more expensive. So the first quarter showed great growth in our economy, the U.S.
And you're talking about the GDP, right?
Right. And then the second quarter, it's begun to slow down a little bit because they built their inventories, and so now they have excessive inventories of raw materials, so now they can do their production. But the second quarter, which has just finished, we don't have those numbers yet, but it should be lower. And so that might incentivize the Federal Reserve to lower interest rates in order to keep the economy rolling along.
Now, the Fed key points to what they want to do is they want to keep inflation under 2%, right? That's
They
their
like
mandate.
2.5%. It gets above 3%, and they get nervous. Yeah.
Right. So if they keep, then that was one of the things they were talking about before. Their mandate was to keep it under 2%, and it's been there. It's actually lower than where's it at? Do you know what the core rate is?
Right now, we're at 2.1% on average for the annual GDP. Is what it looks like.
So, all right. So if everything goes the way we think it's going to go, the GDP that's going to come out is going to show a lower GDP, right?
Well, yeah, they're actually anticipating a lower GDP by 2020 of 2%, but 0.1% is splitting hairs. So we're going to see. I don't think the Fed should lower interest rates this summer. I think the economy is clipping along pretty well, and I think we should stay out of wait-and-see policy, although he's been dovish this last few times he's talked, and that sounds as if he is willing to lower interest rates. If he doesn't lower interest rates after the next meeting, there will be a backlash by Wall Street. They'll penalize him a little bit. A short-term sell-off, yeah.
And for our listeners who don't understand those terms, dovish and hawkish, what does that mean?
Dovish is soft. Hawkish is firm or strong. Hawkish would mean he's looking at raising rates because he's concerned about inflation. Dovish is he's giving in because he's concerned about a recession.
Okay,
so he wants to stimulate the economy by lowering interest rates and slowing down the economy by raising interest rates.
Right, and it's just not him. I mean, because they look at everybody on the Fed.
There is a board of governors, yes. So it's not one man making a decision.
Right,
it's a general consensus.
And they could have 3 doves and 5, 4, whatever the number.
Right now, I think the consensus is there's 1 or 2 really pushing for a discount rate. There's one that's absolutely adamantly opposed and thinks they should raise rates, and the rest are like walking the line.
Yeah. I mean, for most people don't realize that what they do, it only has to do with short-term interest rates, which was like credit card, equity lines of credit, certain other things. It has nothing to do with mortgage rates.
No, it's the rates that the banks borrow from the Federal Reserve.
Right. So, and that's totally different because, I mean, if they do nothing, I mean, right now interest rates have been dropping and they look like they're going to continue to drop, but we don't really know until, next quarter and see what happens. But it's a little weird to see. I got in this business. I was taking people from 13 to 9, and they loved me. And then we started this last year. People are getting 4%, and they're like, "What? I can't believe how high the rates are." You know what I mean? It's like, and now we're supposedly, technically, from what I was seeing, from the people in my industry say, we're going to go lower than we did last time. I don't know if I'm going to see that. I'm telling people, take advantage of what you see right now. Go for it. If it's good enough, we can always do it again.
Perspective always helps. My first house, when my wife and I bought our first house, we were looking at 17% interest rates, which kept housing prices low and, of course, kept us out of the market.
Wow, 17%. Yeah. And the average probably price of a home back then was $80,000, $80,000.
I think we paid $64,000 for our first home.
Yeah. And that was probably expensive back then.
It was a modest home.
Well, it was probably Modesto, right?
It was.
Yeah. So, I remember in the 80s, my parents bought a house and it was $80-some thousand.
Yeah, this was 1984.
Yeah. The good year.
I don't want to go back.
All right. So we talked about the Fed a little bit about what they do with their rates. What else do you see?
Well, unemployment rates are extremely low right now. In fact, they're the lowest that you and I have seen in our lifetime. And so right now, unemployment is at about 3.6%. And generally, unemployment at its low is a strain on the economy because generally manufacturers and employers have to pay a higher wage to get more people to work, or they have to steal employed people from other jobs. And so there becomes a more competitive wage when unemployment is low. In other words, if there's lots of jobs available and there's few jobs available and lots of people looking for work, you don't have to pay as much. It's a supply and demand issue. Right now, there's few employed people that are employable and a large demand for employees.
So you're talking about wage inflation? Is that what you're talking about?
I'm talking about wage inflation due to a low unemployment rate.
Do we have that wage inflation?
We don't. And that's one of the reasons that I'm thinking that we might divert a recession, because generally wage growth increases prior to a recession, and we have not had any serious wage growth. since the late 80s. The average growth in wages is 4%, and we are still below that, at 3.4%.
And again, for our listeners, if you want to see this, we'll have this on our Facebook page. So how was our wage during the, recession? Basically from 2006 to 2010, or, do you have those numbers?
I do. From 2006 to 2009, we were above 4% wage growth. So right in the middle of the beginning of that recession, wage growth was above average right now, or then, and now it's well below average. But now understand that wage growth was down to 1.5%. That means the increase in the wages that we were earning as employees was only growing by 1.5% back in 2012, and now it's growing at 3.4%. So what would really stimulate wage growth and could really force a recession could be a national increase in the minimum wage. If you push minimum wage to $15 or $14 or $13, you might see a real impact on the economy, because that would push beginning wages up much higher.
And also, then you'd probably see some companies do away with those jobs and make it more automated.
They're already doing it.
Right.
Yeah, go to the Amazon Center and you'll see few people and lots of robots.
Wow. So there's a lot of things to think about, and whether or not
If wages go up that significantly, then you're going to see people looking for alternative methods or fewer employees, and they'll expect a higher production out of their existing employees.
Don't we do that anyway?
We are trying, yes.
Right. You got all these cars that's going to drive themselves. You have these, semis that are going to be driving themselves.
No, I'm not so sure about that. The technology's there, but I'm not sure the people are willing to give up control. But that's just my opinion.
Well, not yet.
Yeah.
Maybe our generation's not, but I'm sure there's other generations who are willing to do that.
Yeah, maybe. The next generation might be willing to give up control and allow a car to tell them where they're going to be.
Yeah, they just don't care how they get there.
There's certainly an application for that. If someone's disabled, obviously self-driving automobile or transportation would be advantageous. But from my perspective, a truck driving down the highway without a person in it is a huge liability, because there's no one protecting past people all walking down the road or other cars.
Right. To me, it's still scary for me. I'm just thinking about it.
It's a possibility. But if it occurs, then that's lower wage. That's a loss of a job.
Correct.
And those are the kind of jobs that we really need.
Right. Because actually, from when I checked a while back, California and Texas, there was a huge need for, besides construction people, truck drivers.
There is a big demand for truck drivers, and especially hazmat truck drivers. Yeah.
Well, those should be automatic drivers.
No, people that know how to respond to hazardous waste issues.
Oh, really?
Yeah, someone's driving a gas truck or a truck with some sort of chemicals in it or fertilizers. Those are hazardous waste types of jobs where there's a high demand.
And didn't your family used to be in the petrol?
My family was in the oil distribution and gasoline transportation business. Yeah.
So you would know about that.
Well, I know a little bit about it.
Yeah. All right. So let's go out to a break, and when we get back, we'll pick that up.
Sure.
All right. We got to head out to a break. I'm a veteran, like most people know, and I usually talk about members of our military and honoring veteran business owners. But today I want to give a shout out to my son who left for the Army on Monday. His mom's still sad about it, but he finally got there on Wednesday, and he said he's in South Carolina, and he said it is very hot and humid. But, that's least of his worries right now. So we'll talk to you when we get back. And remember, you can call us at #250, say that keyword Real Estate Jerky, and we'll take it from there. Have a great day. Bye. All right, so we're coming back. That's 1 and 2, so we got 12 minutes and then 10. Wages, GDP numbers, inverted yield curve.
I was writing down the slides you're going to want. Wages versus unemployment.
Gold. Anything to gold prices?
I'll find something. That chart's probably not here. And then
You got to, we put it on Saturday.
Real GDP. Page 18.
So when we come back, I want to go back to unemployment.
Right.
And so about increasing unemployment, is that a sign, a true sign of recession? Does that mean what at the lowest we go? Then if it starts ticking up, then that's when the recession hits. How does that work?
Unemployment is a result of the recession.
Is that what you?
Unemployment doesn't.
Because she has on her side there was 2 consecutive business quarters negative growth, Treasury rates, increase in unemployment.
Increase in unemployment is
All right.
a result of a recession.
So what we can do is, all right, so we kind of left off with unemployment where we're at.
The low unemployment is the indication. Usually the lowest point of unemployment precedes the beginning of recession.
Right, and that's one of the charts I have.
Yeah.
Shows that each time we hit here, we start going recession. Start going. But the question will be, how long can we keep low unemployment?
Yeah, and the other issue really is unemployment doesn't really indicate the people that have stepped out of the job market. It's the people that are looking for jobs.
Right. Right. So we're reading that. But next one would be how to protect yourself in a recession.
Okay.
And we can talk about that. We've got 12 minutes. And then signs of slow growth, which has wages and management, GDP numbers, inverted yield curves, kind of the same thing. So, and then these are just stuff she had on here for me to ask about. So when we come back, we'll come back and just rehash the unemployment thing, and then we'll go into, well, how do you protect yourself?
Right.
And last 10 minutes, we can just, figure something.
Right.
So we got 12 minutes. It's not so bad.
We can also talk about the components of GDP or what the GDP average numbers have been historically before and after recession.
Okay, so how about this? I'll bring us back and you can just
ramble.
let everybody know how much you know.
Oh, jeez. You'd be here for hours and hours.
Well, that's like, for what I know, it's like, you never know. I mean, I have some people right now, I'm doing self-employed and, guy wanted to add on his dad to the thing to help him qualify. I won't get into whole details, but it's like I didn't want to because I know the dad owns like 5 businesses, and now we have to go through all the K1s, adds back in depreciation, all the losses, and put all this, and it's like a nightmare. Luckily, I have staff members to do that now.
That's good.
Whenever you're ready.
Get your serving size of Real Estate Jerky on Power Talk 1360 KFIV.
And we're back. I'm here with my guest, Tom Bryant, Managing Director of the Investment Consulting Group here in Modesto. And we're talking about the economy, specifically about the signs of recession, the difference between a recession and slow growth, and what you, our listeners, can do about it. Tom, let's talk about how these things affect my industry, mortgages, housing market, all that. And also we'll bring up about unemployment that we left a few minutes ago. So,
all right.
For me, how do these things affect my industry? Interest rates go low.
Right. Interest rates will go low because the demand for money has reduced because people are in a recession, so they're not confident to borrow.
Right.
So that lowers your interest rates.
And then what most people do is they go out and buy a home.
It's a good time to buy a home. Yeah.
Right, because rates are low. And that's what a lot of people are worried about. If we go into recession, their values are going to go down. What do you think about that?
Well, they might on the short term, but it also gives you cheaper money, which is the opportunity.
Right. But did you know there's only been 2 recessions that house prices went down? I have a chart for that. That's why I didn't know if you knew that.
I did not know that. I probably lived through one of them.
Yeah, 91, 92, house prices went down about 3 to 5%. And then the Great Recession, I talk about all the time, the actual real estate market took us into a recession, right? And that's became the Great Recession, or what most of us said, the Depression. And during that period of time, house values went down drastically, and that had nothing to do with the recession. That had to do with the housing market falling apart.
And there was a lot of opportunity during that time, too.
For a lot of people to buy who didn't have a chance to buy before, and a lot of people bought multiple houses, right?
Right. A lot of investors went out and bought a lot of real estate because their cash flow on those things were amazing because they could rent them out. Because a lot of people actually lost their homes.
Right. And a lot of those people who lost their homes are bought again right away, or, but what we see from that is we see a lot of people in their children of people who have lost their homes don't want to go out and buy a home because of what they lived through with their parents.
And I don't understand why that is, Ed, because to me, it seems like any time that you can buy a home and build equity and do it for the equal amount of a rent payment, or in some cases less than a rent payment, you'd be crazy not to buy the house.
Right. And for me, I look at it, for most people, they don't, we had your son on here, if that's okay for me to say, and he does 401ks, 403bs, and all that. And most people, and IRAs, most people don't invest in that, but they can go buy a home and then they can build personal wealth that way. Yes, it's harder to access that as in those other things, but at least it's a way for them to build personal wealth.
I absolutely agree. And also,
thank you. I'm glad you didn't say I don't agree.
And also, you have made it so it's not that difficult to access the equity in the home, so people can actually get access to those that increased value if they need it.
Right. And I've actually, because I was against people refinancing and paying off short-term debt, but I've seen some programs that I put together lately that if you do that and then the money that you save per month, add it back in and pay down the mortgage, you can actually pay that off in half the time. It's amazing.
Yeah, as a general rule of thumb, borrowing against an asset that if you don't have to is not a good idea. I too advise people not to borrow against their 401k or 403bs or retirement accounts, but because those are assets that are being put away for a later date. But if there's the right opportunity, it makes sense.
Right. Because I actually, during the Great Recession, I knew a lot of people who cashed out of their 401ks and 403bs and went out and bought real estate with it.
Yeah, and it works. But the penalty for those people was horrendous. They ended up with 50 cents on the dollar, so they better make some good money on the other side.
Well, a lot of them did.
Yeah.
So where do you want to go from here?
Well, let's talk a little bit about you want to speak briefly about the unemployment issue again, or the unemployment numbers.
Right. Because I don't think people really realize how low unemployment is and how that affects us, and the fact that there's no wage inflation, which normally there is at this point. Right?
Yeah, wage inflation is becoming an issue, but it has not as a average rate of return or average return. It hasn't grown on average as much as it should have, and so that is an indication that we might not be in a recession or coming into a recession. But one of the reasons that wage or unemployment rather is so low is, and we haven't talked about this, is that there are a lot of people that left the employment realm and aren't looking for jobs. They just dropped out. And so what unemployment actually measures is people that are actively looking for jobs that are unemployed. And so as you and I know, as you walk down the streets, there are a lot of people that just aren't working. And so that keeps these unemployment figures, they're a little skewed. They don't tell the whole story. But generally, unemployment increases after a recession starts because companies are laying people off because they're earning less, and so they have reason to do that. So, unemployment at this number is certainly could be considered an indicator that we might be coming to at least a slowdown in our economy, not or maybe a recession. But
again, a slowdown. I mean, California is unique, right? We're in California as a state
in so many ways.
Yeah, let's not go that way. Where a national slowdown doesn't always affect us.
That is correct.
So, I mean, we're our own economy, right? We're number 7 in the world?
I think we're 5.
5? Okay.
Yeah.
So I knew we were close to that.
Yeah.
So, I mean, that's a totally different. But I can see when you talked about in the last segment about if the wage for the $15, what's the word I'm looking for? The first minimum wage. Thank you. Gosh. Goes to $15, how that could affect people.
Yeah, it's like $7.50, I think, in some states, and in California, is it $13 now? It's $11. It's creeping. I know that. Yeah. In some of the major cities, it's $13 or $14.
Well, some places are already paying $15 as their minimum.
Yeah, well, in some places you have to pay that just to get somebody that will show up on time. Right. That's clean and sober. Right.
And I mean, because like a lot of the smaller states in the United States, I mean, you look at their house to buy a house. I mean, you're talking 160, 110. So to pay $15 an hour for someone to work, it's that's going to be huge for them.
That would be a living wage anywhere. Yeah, except for California or the coastal states. Yeah. You want to talk about GDP?
Okay. What's GDP?
GDP, gross domestic product.
And of course, I knew what that is.
Yeah, I
just
know
want to
you
make sure I listen.
It encompasses, it measures consumption,
Okay.
government spending, and investments, not including housing, and housing. Housing is only 3.8% of the GDP.
Right, and also the problem with the GDP is you're talking this year how people were building up their inventories because of the tariffs coming in, and then that kind of skewed the GDP. So it's basically a statistic, and you can skew statistics, right?
Another thing that is 17% of the GDP is government spending. So if the government slows down their spending, that has a big effect on the GDP. And right now, the government's spending a lot of money, actually more money than they're taking in. Surprise.
Yeah. Well, I mean, so with this celebration for the 4th that's in the D.C. area, that's going to be good for the GDP, right?
It's always good for the GDP when people spend money. And 68% of the GDP is our consumption, yours and mine.
Okay.
We buy cars, we buy food, we buy fuel, we spend our money. And so that's what GDP really measures. 68% is your and my spending, average American spending habits, and that's still positive.
And so, all right, so if we go back, has it went up, went down, stayed stable?
Our GDP
our consumption, our personal stuff.
Yours or mine?
You know what I mean?
Yeah, I know. GDP has on average been 2.7% historically, and that's going back to 1969. So, quite 40 years. I guess that's 50 years, huh? And so right now we're slightly above that. We're right now at 3.1, so we're slightly above the average of 2.7. The last time we went into recession, we got as high as 4.5% GDP. So
that would be the 2006 recession.
That was 2000 actually.
Okay.
Leading down the recession. Right before we started that recession in 2008, we were at about 2.2. So
during the recession,
less than what we are now.
During the recession, how far did that go down, or did it?
Oh, GDP was negative 4%.
Wow.
On an ongoing basis for about a year and a half.
For personal consumption?
Yeah.
Wow. So, nobody bought anything.
Well, I remember going into Costco and being only one of like 5 people there. It was shocking. But people spent a lot of less money. So one of the things that you see is a slowdown in consumption by individuals would be a definite signal that we are in or coming to a recession.
All right. But
generally people, though, react. Once they're in the recession, they react.
Well, and then like we talked about before, it takes 2 quarters to be in it before you know you're in it.
2 negative quarters constitute a recession.
Okay. So I want to go on the Fed, right?
Right.
And how well do they predict us going into recession?
Well, they haven't been that successful, actually. In fact, more often than not, our indicator suggests that the Fed actually exacerbates the recession. Because they overreact to growth in the economy by raising interest rates fairly high, too quickly and causing a recession. And I've seen this twice in my business experience.
I actually saw a chart where they were saying when the Fed said we were going into inflation, they were 15% right. The last 4, and then when we were in the Great Recession, they were at 45% of them said we were in a recession.
Yeah, well, at the Great Recession, the Fed discount rate was at 5%, and right now we're at 2.38. So they can have a big impact. And in 2000, when that recession came, right after the Y2K, the Fed was at about 6.5% discount rates. You can buy right now. 30-year Treasuries are like 2.3, so they can cause some trouble for us.
Of course they can. So basically, we have about a minute before we go to break, and we didn't talk about how to protect yourself yet. Correct?
Yep.
All right. So when we come back, we'll pick that up. Is there anything you want to add before we go to break?
There's so many things I'd love to add, but no, there's nothing. I'm good.
All right. So why don't we use this extra time for the next segment? All right. So we're going to go to break. We'll be right back. Thank you for listening to Real Estate Jerky. You remember you can listen to us 24/7 via our podcast, also at iHeart.com, iTunes, or you can just Google us, Real Estate Jerky, and find us. We'll talk to you when we get back. All right, so we'll have about 10 and a half minutes when we get back. Cool. So this last part is going to be all about how to protect ourselves. Are you ready? Shoot. We doing okay?
Yeah, I'm doing great. It's not boring. It makes sense.
All right, the last 10 minutes all about how to protect yourself.
Wear condoms.
I love
I was gonna say, wear a recession condom.
Behave yourself. That's how.
Oh my goodness.
Don't do anything stupid.
Okay, look up.
Buy land.
3, 2, 1. Recession kind. Wait, that wasn't fast. That was too fast.
Too fast. Just look at, you gotta look at her.
Yeah, put your headphones on.
No, the headphones on.
Yep. And
Hey.
2, and 2, and 1. Yay. Thank you. Yay!
Ready? Oh, and then as soon as we're done with this, I have a minute. I have a thing I gotta read afterwards. So we'll finish, and then you guys will all leave, and I'll do my minute.
Leaving the bull behind. It's Real Estate Jerky.
And we're back for our final segment of our show. I'm Ed Parcaut, your mortgage advisor at Lending for Living, with my guest, Tom Bryant, managing director, the investment consulting group here in Modesto. All right, Tom, we've been focusing on economy, GDP, and a little signs of recession. How do we protect ourselves? How do our listeners protect ourselves from this recession? Not that we don't know if one's coming, but what would you recommend people do?
First of all, don't panic. If I were anticipating a recession, I would be doing a couple of things. One, I would be building cash, because recessions often provide opportunity. So I would be building cash, which in my office we do build cash all the time. We're always collecting cash for our clients, and we're building it, looking for the next opportunity. I would be buying short-term treasuries, and that's what the yield curve tells us right now. That's why the short-term yields are higher than the long-term yields, longer-term yields, because people are buying short-term in fear of a recession. So that money will be available to invest in the next 6 months to a year. So you could buy short-term treasuries, have a money market fund that pays a nice high rate. I certainly wouldn't walk away from investments that are giving me cash flow of 4%, 3 or 4%. So I wouldn't do that. And I would probably not be looking at buying aggressive growth stocks if I am anticipating a recession.
Because during most recessions, stock market goes down, right?
Not always, but the market will react to a protracted recession. So once we're 3 or 4 months into negative GDP, the market could start reacting negatively, yes.
And that would mean they could go down 20%, 40%,
Well, and there's been times, Ed, when the stock market has kind of caused a recession, too. Surprise.
What year was that?
There's been several. So the market will tend to be 3 to 6 months ahead of what the economy is doing. So they will, if it anticipates a recession, it could sell off to 10 or 20%. But we've seen 9 or 10% sell-offs like last winter. Between October and December, we had about a 15% sell-off cumulative between those 2 months.
And now isn't it back up to its
Oh,
high
yeah.
again?
We're back up to, in fact, we just broke October's high of last year, and the S&P Standard & Poor's 500 is making new highs. As we spoke today, it made a new high.
Wow, that's amazing. So what do we do? So be careful.
Buy really good investments that provide you with cash flow. Look at real estate. That if you're buying real estate for an investment, of course, you're going to be smart enough to look for the cash flow, what kind of cash flow you're going to be getting on that. Keep your powder dry. If you're looking for a great investment and you're anticipating a recession, then you should hang on to your cash.
Okay.
A wise man once told me to always hang on to. He had millions, and he'd said I would approach him about his cash, and he'd say, "That's my opportunity money." And he always was ready to take advantage of a recession or when a great opportunity came along. And they tend to be more obvious during a recession.
And typically recessions in the past, except for the Great Recession, how long do they normally last? 18 months to 2 years? I mean, is there
Generally 2 to 3 quarters.
Oh, so it's not that long at all.
No, it's not. It hasn't been, except for the 2007 to 2008. 2009, it began to recover, but the market was down 50%. And I think the real estate market followed that. So the stock market was down 50% over a 2-year period, but it took real estate 3 or 4 or 5, 8 years, I guess, to really 5 years to really completely unwind itself.
And that was because of the overbuilding during 2005 and 2006.
Overbuilding, and some say it was probably because there was an oversupply of money. Money was really easy to get their hands on. Remember the subprime lending?
Yes, totally remember that. But there were some programs that should have never been brought up or done, and those won't be done again. And one thing about today is most people are putting money down. Right, there's not the 100% financing except for VA and USDA, but I mean that back then anybody could buy a house at 100% financing, 80% first and then 20% second. So it created issues that we are not going to see. So,
well, I would have to defer to your expertise on that. So if you say so,
I mean that was there was loans where. Do they have a pulse and they could buy the house?
That's right.
And those were the issues. If you have no skin in the game, you're more likely to walk from your house. Right?
If you have no skin in the game, that's right. People were walking because they got a free boat and a new truck out of the deal. They refinanced their house, got a boat and a truck, and then walked away from their house when it dropped in half.
And then some people would go out and they went and waited and bought another house before they let the other house go. So.
That's right. And that's one of the arguments why it took a while for our economy to recover is because lending is not as loose as it was back then.
It's not it's not super difficult. You just have to have, you have to be able to have the credit. You have to have the down payment. You have to have income. The things that you supposedly should need to buy something.
And a history of paying off your student loans.
That's one of the issues that we're going to see going forward is because the student loans debt is so great for a lot of these young people that I came across somebody who had $484,000 in student loan debt, and she's just becoming a psychologist. And other people, I've talked to other people, and they've run across people with $240,000. And so what is that cost of getting that degree? Is that worth it for some people? And that's what people have to look at over the next few years.
Well, they should have been looking at that years ago.
I know, but a lot of people, they want to be the first one of their family to have a degree, and then they don't know that issue, that happens. And
again, they're awfully easy to loaning these people this money.
Yeah. And maybe it shouldn't be so easy, but that's not what we're here about. We're here about the recession and what to go forward and how to protect yourself. So basically, from what I understand now is, we have the signs. You want to go through the signs real quick?
Inverted yield curve, low unemployment.
Gold prices.
Gold prices are higher than they have been. They're up about 15% from the low in December. And
and we said unemployment, right, already?
We talked about unemployment. Wage growth is a negative. It's not going up as much, so that's on the other side.
So if we do see wage growth start going up, then we need to start worrying.
You should always be ready for it.
All right. So we see those, but nothing major right now that we can put our.
I would think that it would take something catastrophic in our economy, something surprising. That could, if it happened overseas, or it could happen at home. And let's hope that doesn't happen. Let's hope our government's on their toes.
So with the tariffs, right, that are still in play with China, and and then things that are going on with Iran, how do you see that affecting us?
Well, those are the unknowns. Iran is a scary situation. The majority of the people there and here don't want a conflict.
Right.
But we've got some people that are that have full control of a lot of dangerous stuff, and if they decide to deploy that, it could create a real problem. Let's hope and pray that they don't, and let's hope that our government has some real bright people that are talking to those people.
Right, and I think nobody wants to go to war. Right. Everybody, but you're going to have those extremists on every side that can push real easy.
Surprisingly, though, short term, a little bit of conflict is good for the economy, our economy.
Yeah, it stirs refinance booms.
I don't know about that, but we own 4 defense stocks in our portfolio, so it's been good for us.
So during a recession, alcohol, tobacco, firearms, what did I say to put your money into?
Actually, the sin stocks, no, they're all good investments. Actually,
all the time?
Not all the time, but generally, those are the companies that are increasing their dividend yield because their earnings are constantly growing, and they're constantly increasing their market share because more people are selling more beer and more whiskey, and guns have been a problem. Gun companies have been out of favor, but they have been making good money. And the last president was probably the best gun salesman that these gun companies have ever had working for them.
All right. Well, that's all right. So we have about,
not really a recession type of stock, but
that's what they used to say. Is when you always go back to those when you go to hard times.
And recessions,
people always drink hard when they're
going and from my perspective, recessions are the time that you buy non-cyclical, non-durable goods types of stocks. Johnson & Johnson. I'm sorry, I shouldn't be talking about individual stocks, but companies that generate you'll always need their products. And by the way, alcohol and tobacco, people always need them, or at least want them.
Right.
And sometimes
makes life a lot easier.
Sometimes they put their wants ahead of their needs.
That's right. Hey, Tom, I want to thank you for being here today.
Sure, it's been my pleasure.